Oil prices tumbling today despite renewed tensions in the Middle East this morning and overnight after Israel accused Iran of breaking a ceasefire deal and firing missiles. President Trump making critical remarks aimed at both nations and reiterating on Truth Social that the ceasefire is in effect. Wall Street appears hopeful around a ceasefire with stock futures moving higher while oil prices fall. Here to dig into the moves in oil, we've got Andy Lipow, who is the president of Lipow Oil Associates. Just first and foremost, just take us into your assessment of the developments over the past 24 hours with the calling for a ceasefire and the markets responding to the ceasefire announcement, but then what continued to transpire overnight and how the oil markets are reacting there.
Well, good morning, Brad, and thanks for having me. The oil market sell-off started about lunchtime yesterday as Qatar was seeing missiles being shot at it from Iran, but it was a limited number of missiles, and the oil market interpreted that as really a symbolic retaliatory strike that was intended to be more symbolic for the people of Iran rather than to cause damage to American facilities. With that happening, the oil market began to discount the possibility that the Strait of Hormuz was going to be shut down, and then hostilities might even be cooled in the region. That was followed by about 5 hours later with President Trump announcing a ceasefire, and the sell-off in the oil market continued. Now the oil market is going to look ahead to determine how long the ceasefire can hold, and will it actually lead to a reduction in the hostilities in the region?
And so do you believe that longer term for oil markets that we can take off the table us having the risk of getting to $100, $125 a barrel type of prices for contracts?
Well, I think the probability that the Strait of Hormuz is going to be completely shut has been reduced quite substantially. And that's why you're seeing oil prices come off as much as they had. If we look beyond the Strait of Hormuz, the oil market is well supplied. We're getting increasing supplies out of Argentina, Brazil, and Guyana. At the same time, the International Energy Agency is only forecasting oil demand growth to be about 700,000 barrels a day. And this is coupled with OPEC Plus restoring their voluntary production cuts that they instituted several years ago. They've already restored 1.4 million barrels a day of production since April. The plan is to restore another 800,000 barrels a day, probably by October.
Andy, I wonder what your belief is in terms of the companies that are likely or unlikely to do what President Trump was asking for via social media, once again, in the drill baby drill commentary, which once again was, of course, tossed out there by the president as all this was taking place on the geopolitical and Middle East conflict front. Are companies actually likely to do that?
Well, I think the Trump administration is helping to ease regulation so that the drilling companies can lower their costs. But on the other hand, the drilling companies really are looking at the price of WTI because that's how they monetize their crude oil. And if crude oil prices remain around $60 a barrel, they're unlikely to increase their capital expenditures to drill more wells. On the other hand, if they saw a substantial increase in oil prices and sustained levels at above $80 a barrel, the reverse would happen, and I think they would increase their capital expenditures and increase their drilling activity to get more oil out of the ground. But they're really, at the end of the day, driven by the price of oil as well as the price of natural gas.
And so all of this in mind and the timeline that we've seen play out, did oil prices remain elevated long enough for it even to have a material impact to the futures contracts, so much so that if a contract was priced at an elevated level, that taking delivery would be so expensive or elevated expense that would then pass along to consumers? Because that's perhaps what investors would also have to wrap their minds around too, in the time frame for how long prices were elevated.
Well, prices were elevated. I think some hedging activity did occur over the last day or two, but I don't think that the prices were high long enough for oil producers to make decisions on long-term capital expenditures. So I think that this real spike, which was very short term in nature, really did not do anything to move the needle regarding drilling here in the United States.
Andy, good to speak with you as always. Thanks so much for taking the time this morning.
Thanks for having me.